वेलकम टू वी लर्न में आपका स्वागत है। सब्जेक्ट इंडियन फाइनेंशियल सिस्टम, सेशन नंबर 7। टॉपिक कवर्ड इन दिस सेशन: मनी मार्केट इन इंडिया, पार्टिसिपेंट्स इन मनी मार्केट्स, डिस्काउंट एंड फाइनेंस हाउस ऑफ इंडिया लिमिटेड DFHI, रिजर्व बैंक ऑफ इंडिया, वेरियस कंसेप्ट एंड इंस्ट्रूमेंट ऑफ फाइनेंस, एंड नाउ मनी मार्केट। जैसा कि आपको लास्ट सेशन में मैंने बताया था कि हमारे फाइनेंशियल मार्केट के अंदर दो तरह के मार्केट होते हैं। एक कैपिटल मार्केट होता है, एक मनी मार्केट होता है। कैपिटल मार्केट के अंदर हम क्या करते हैं, लॉन्ग टर्म सिक्योरिटी को जिस मार्केट से ट्रेड किया जाता है वो आपका कैपिटल मार्केट कहलाता है। जबकि मनी मार्केट जो है वो क्या होता है, जहाँ पर शॉर्ट टर्म सिक्योरिटी को ट्रेड किया जाता है वो हमारा मनी मार्केट होता है। द मनी मार्केट प्रोवाइड्स ए मैकेनिज्म फॉर इवनिंग आउट शॉर्ट टर्म लिक्विडिटी इम्बैलेंसेज विद इन एन इकोनॉमी। शॉर्ट टर्म लिक्विडिटी के इम्बैलेंस को पूरा करने के लिए मनी मार्केट जो है इम्पॉर्टेंट होता है, यूज किया जाता है। द डेवलपमेंट ऑफ द मनी मार्केट इज दस ए परक्वेजिट फॉर द ग्रोथ एंड डेवलपमेंट ऑफ द इकोनॉमी ऑफ ए कंट्री। और किसी भी इकोनॉमी के डेवलपमेंट के लिए, ग्रोथ के लिए मनी मार्केट एक परक्वेजिट का कार्य करता है। पार्टिसिपेंट्स इन मनी मार्केट, कि मनी मार्केट के अंदर कौन कौन से इंस्टीट्यूशंस, कौन कौन से संस्थान पार्टिसिपेट करते हैं। नंबर 1, रिजर्व बैंक ऑफ इंडिया। रिजर्व बैंक ऑफ इंडिया इज द रेगुलेटर ओवर द मनी मार्केट इन इंडिया। जैसा कि सेशन नंबर 3 में मैंने आपको बताया कि रिजर्व बैंक ऑफ इंडिया इज फंक्शनिंग एज पर द रेगुलेशन ऑफ रिजर्व बैंक ऑफ इंडिया एक्ट 1949 और रिजर्व बैंक ऑफ इंडिया एक्ट 1935। रिजर्व बैंक ऑफ इंडिया is an apex institution to regulate the other financial institutions or services in entire the nation. As the central bank, it injects liquidity in the banking system when it is deficient or deficit and contracts the same in opposite situation. Then banks, commercial banks and the cooperative banks are major participants in the Indian money market. They mobilize the saving of the people through acceptance of deposits and lend it to business houses for their short-term working capital requirements. बैंक जो है, कॉमर्शियल बैंक हमारे दो तरह के कार्य करते हैं। एक, मोबिलाइजिंग द सेविंग ऑफ द पीपल्स की जो सेविंग होती है उसको मोबिलाइज करते हैं एज पर द मीडिएटर्स थ्रू द एक्सेप्टेंस ऑफ डिपॉजिट्स लेते हैं एंड लेंड इट टू बिजनेस हाउसेस, और उस मनी को बिजनेस में लेंड कर देते हैं फॉर देयर शॉर्ट टर्म वर्किंग कैपिटल रिक्वायरमेंट। बिजनेस हाउस को वर्किंग कैपिटल की ज़रूरत होती है, और वर्किंग कैपिटल क्या है, उनकी डे टू डे नीड को पूरा करने के लिए जो ऑर्गेनाइजेशन फंड मेंटेन करते हैं वो उनकी वर्किंग कैपिटल होती है। तो उस डे टू डे फंड के लिए बिजनेस हाउसेज को लिक्विडिटी की ज़रूरत होती है, शॉर्ट टर्म फंड की ज़रूरत होती है, एंड दैट इज प्रोवाइडिंग बाय द बैंक्स और कॉमर्शियल बैंक्स। While portions of these deposits is invested in medium and long-term government securities and corporate shares and bonds, they provide short-term fund to the governments by investing in the treasury bills. They employ the short-term surpluses in various money market instruments. And our Discount and Finance House of India Limited, DFHI, deals both ways in the money market instruments. Hence, it has helped in the growth of secondary market. as well as those of the money market instruments, financial and investment institutions. These institutions like LIC, UTI, GIC, development banks, etc., have been allowed to participate in the call money market as lenders only. Number 5, corporate companies create demand for funds from the banking system. They raise short-term funds directly from the money market by issuing commercial paper. Moreover, they accept public deposits and also indulge in inter-corporate deposits and investments. Number 6, mutual funds. Mutual funds also invest their surplus fund in various money market instruments for short-term periods. They are also permitted to participate in the call money market. Money market mutual funds have been set up specifically for the purpose of mobilization of short-term funds for investment in money market instruments. And our Reserve Bank of India, India plays a very significant role in the Indian money market. The various tasks being performed by the Reserve Bank, it manages the liquidity in the money market by granting refinance facilities to the banks. And by stipulating the reserves requirements, cash reserve ratio CRR and statutory liquidity requirement SLR are the principal tools to effect the liquidity with the banks. हम ये कह सकते हैं कि रिजर्व बैंक ऑफ इंडिया के पास लिक्विडिटी को कंट्रोल करने के लिए मुख्य रूप से दो टूल्स होते हैं. पहला CRR, कैश रिजर्व रेशियो, एंड नेक्स्ट इज लिक्विडिटी, स्टेट्यूटरी लिक्विडिटी रिक्वायरमेंट्स मीन्स SLR. और ये क्या है? ये बैंक जो है, जो भी हमारे कॉमर्शियल बैंक हैं या नेशनलाइज्ड बैंक हैं या प्राइवेट बैंक हैं, वो सभी एक पर्टिकुलर परसेंटेज में अपने डिपॉजिट्स का पार्ट रिजर्व बैंक ऑफ इंडिया के पास एज ए सिक्योरिटी रखते हैं. ये पार्ट जितना ज़्यादा होता है उतना ही बैंक्स के पास पब्लिक डिपॉजिट कम हो जाता है या फंड कम हो जाता है. जितना पार्ट कम होता है उतना फंड ज़्यादा हो जाता है. और जैसे फंड ज़्यादा होता है बैंक के पास में तो लिक्विडिटी बढ़ जाती है. जब रिजर्व बैंक लिक्विडिटी को कम करना चाहता है तो CRR रेट बढ़ा देता है, और जब लिक्विडिटी बढ़ाना चाहता है तो CRR और SLR रेट बढ़ा देता है. तो इस तरह से लिक्विडिटी कंट्रोल की जाती है बाय द रिजर्व बैंक ऑफ इंडिया. Reserve Bank of India has been providing in the past refinance facilities to the banks through different schemes which were in operations from time to time. The Nasimham Committee on Banking Sectors Reform 1998 recommended that the Reserve Bank of India should provide support to the market through a liquidity adjustment facility. Interim Liquidity Adjustment Facility, ILAF. Under the ILAF facility, liquidity was managed through a combination of repos, that means repurchase agreement, export credit refinancing, collateralized lending facilities, open market operations at set rate of interest. And now, repo is a method of borrowing against certain securities for a short period. The borrowers undertakes a commitment to purchase back or to take back the same securities after the specified period at a predetermined price. The difference between the two prices is treated as interest on the amount borrowed. Reverse repo is the opposite practice wherein the lender lends against the securities with the commitment to take back the securities from the borrowers against payment at a specified price. Thus, by reverse repos, the Reserve Bank contracts liquidity from the system. Collateralized lending facility. Under this facility, banks' money market in India banking system and were provided funds up to 0.25% of their fortnightly average money market outstanding aggregate deposits in 1997-98. This facility was available for 2 weeks at the bank rate. An additional collateralized lending facility ACLF for an equivalent amount at the bank rate plus 2% was also made available to banks. These funds could be utilized beyond 2 weeks at a penal rate of 2%. This facility was introduced with effect from June 5, 2000 and will be completed in 3 phases as follows. Number 1, the ACLF for bank and level 1 liquidity support to primary dealer have been replaced by variable reverse repo auctions. The fixed rate repo has been replaced by variable rate repo auctions. Number 2, in the second stage, CLF for banks and level support to primary dealers will be replaced by variable rate reverse repo auctions. In the third stage, the LAF will be operated at different timing of the day if necessary. Money at call and short notice. Market at call and short notice is an important constituent of the money market. It deals with short-term funds, repayable at call or at a short notice. Initially, the commercial bank used to the participant in this market. Hence, this market was called the interbank call money market. The necessity for such interbank borrowing arises because some banks feel the need for short-term liquidity at a certain time, while other banks have surplus liquidity at that time which they can spare for a short period, that is a day or a few days, and thereby they intend to earn income. Treasury bills. A treasury bill is an instrument for short-term borrowing by the Government of India. It is issued by the Reserve Bank of India on behalf of the Government of India in the form of a promissory notes. The necessity for issuing treasury bills arises because of the periodic nature of receipt of government, while the government expenditure is on a counting basis. Taxes are payable to the government after quarterly intervals or so on, but government has to meet its expenditure on daily or monthly basis. Thus, to bridge the gap, this mismatch between the timing of government receipts and expenditure, government borrows money on short-term basis by issuing treasury bills. Discount and Finance House of India and Treasury Bills was set up by the Reserve Bank of India jointly with public sector banks and all India financial institutions. It was incorporated on 3rd March 1988 under the Companies Act 1956 and commenced its business operations from April 25, 1988. The main objective of establishing DFHI was to facilitate the smoothing of the short-term liquidity imbalances by developing an active money market and integrating the various segments of the money market. DFHI has a share capital of Rs 200 crores which has been subscribed by Reserve Bank of India, public sector banks and financial institutions. Activities of DFHI: it dealing in treasury bills, rediscounting short-term commercial bills, participating in the interbank call money, notice money and term deposits market, dealing in commercial papers, certificates of deposits and government securities. Commercial bill of exchange: commercial bill of exchange arise out of genuine trade transactions and are drawn by the seller of the goods on the buyers or debtors. Where goods are sold on credit, they are called demand bills. When payable on demand or on presentment before the buyer, who is called the drawee of the bills. Alternatively, the bill may be payable after a specified period of time, that is 30, 60 or 90 days. Such bills are called usance bills and need acceptance by the drawee. By accepting the bills, the drawee gives his consent to make payment of the bills on the due date. Thus, payment of the bills is assured on the dates of maturity. These bills are therefore called self-liquidating in nature. Certificates of deposits: a certificate of deposit is a receipt for a deposit of money with a bank or a financial institutions. It differs from a fixed deposit receipt in two respects. First, it is issued for a big amount, and second, it is freely negotiable. The Reserve Bank of India announced the scheme of certificates of deposits in March 1989. Features of certificates of deposits: certificate of deposits can be issued by scheduled commercial banks, excluding regional rural bank, and the specified all India financial institutions like Industrial Money Market in India, Banking System and Development Bank of India (IDBI), Industrial Finance Money Market Corporation of India (IFCI), Industrial Credit and Investment Corporation of India (ICICI), Small Industries Development Bank of India (SIDBI), Industrial Investment Bank of India (IDBI), and the Export Import Bank of India (Exim Bank). Features of certificates of deposits: certificates of deposits can be issued to individuals, associations, companies and trust fund. Number 2, certificates of deposits are freely transferable by endorsement and delivery after an initial lock in period of 15 days, after which they may be sold to any of the above participants or to the Discount and Finance House of India. Number 4, the maturity period of certificates of deposits issued by bank may range from 3 months to 12 months, while those issued by specified financial institutions may range from 1 to 3 years. Certificate of deposits are to be issued at a discount to the face value. Number 6, presently there is no limit on the amount which a bank may raise through certificate of deposits. Initially, though, there was a limit linked to the fortnightly aggregate average deposits of the bank. Number 7, the minimum amount for which they may be issued is now pegged at rupees 5 lakhs, reduced from 25 lakhs. Number 8, the minimum size of issue of certificate of deposits to a single investor is rupees 5 lakhs. Thereafter, they can be issued in multiple of rupees 1 lakh with effect from October 1997. Number 9, bank and financial institutions are required to issue CDs only in dematerialized from the effect from June 30, 2002. TII existing CDs are to be converted into demat form by October 2002. And now commercial paper. Commercial paper is a short-term usance promissory note with fixed maturity issued by credit-worthy and highly rated corporations. It is negotiable by endorsement and delivery. The Reserve Bank of India permitted its introduction in January 1990 as an additional source of short-term finance to corporate and also as an avenue for investment of funds by large investors. Eligibility. Commercial paper may be issued by primary dealers, secondary dealers, and all India financial institutions besides the corporate. The eligibility conditions prescribed for the corporate are: tangible net worth should be rupees 4 crores. It should have a sanctioned working capital limit from a bank or financial institutions. And the borrowed account should be a standard assets. The instrument of commercial paper should have a minimum maturity period of 15 days and the maximum period up to 1 year. Number 2, a minimum amount of rupees 5 lakhs and thereafter in its multiple of rupees 1 lakhs. Number 3, minimum credit rating of P of CRISIL or equivalent rating by other approved credit rating agencies. And now do it yourself. Explain various kinds of instrument used in finance. Number 2, explain the repo and reverse repo. And that's it from session number 7. Thank you.